The difference between trading on a single time frame and a multi-time frame one is the manner of precision. Trading on a single time frame makes the trading process a lot easier, but trading on multiple time frames makes the trading process a lot more precise. The decision between an easy method or a precise method is up to the trader. In the past, I have taught multi-time frame trading, which means using the movement of price on a particular time frame and then going down lower down the time frames in order to determine the specifics of entry and exit. In continuation with the series of planning for the next day's trade session, I have once again set the same indicators, that is moving average crossover of 20 and 50, and set Nifty on the hourly chart. And much like always, we will note the death crossover and the downward sloping moving averages. And today we see that Nifty's close on 22,082 is pretty close to the 20 period moving average of 22,117. So the initial plan for the individual who's trading on a single time frame will be to sell Nifty on a 35 point rise up. So once again, let's just recap this plan. The plan is very simple, that if the conditions of a downward trending market are made, then the idea would be to sell the market, and the plan has to be to sell the rise. If the market is trending, which is confirmed by the indicator ADX, that is, if the value of ADX is indeed above 25, and as we can see, it is currently at 42. If the market is trending, then the manner of going short will be by buying put options. If the market is ranging, then the manner of going short will be by writing call options. So since this is a trending market and a rise has to be sold into, moving averages are used as potential resistance points. We can see today the price action began with a gap down, and pretty much the day's low and the open are very similar. From the day's low of 21,965, Nifty created a day high of slightly over 22,100, which means that during this day it has traveled 150 points from the low of the day. So the trader who is looking at a single time frame would want to sell at the 20 period moving average, which is marked here by a red line, and I'll make it slightly dark, followed up by another sell at the 50 period moving average, which is marked by the other red line, that is 22,420. In other words, the two levels where the market will make us sell the trade, I'll note this down here, at 22,120 and 22,420, the idea is to buy the put options. Once again, the question will become which put options. So for that, we will have to determine the SL. As we have discussed, from the SL has to be with reference to the slowest time frame, which is 22,420 currently, or 418, and we know that the ATR, hourly ATR of Nifty, is approximately 80 points, which means at 22,500 we will have the short side SL for Nifty, which I will mark with a green color. That is, beyond this point, we will believe that there is no reason to continue on the sell positions. Since the SL is 22,500 at spot, therefore the plan will be to buy 22,500 PE with SL of 0 in the intrinsic value. And we will have to add some time value. Since multiple contracts of multiple weeks and months are available for the 22,500 PE, I will leave it up to the trader to determine which PE to buy for themselves. Let's assume that you choose a monthly contract, then the time value of that contract will be significantly higher than the time value of the weekly contract, which in turn will be significantly lower than the time value of the contract with an expiry of 2 weeks. So given the multiple choices, as each expiry determines the value of the option and each account is different. Therefore, each trader may have a different choice. But the plan remains the same. The idea is to short the market by buying an in the money call option, which will be 22,500 PE, with the SL of 0, which will be the intrinsic value, and you will have to add the day's time value to it. As we have already discussed, all analysis done on the hourly chart are only applicable for the next trade session. You will not carry forward that analysis to the subsequent day, and the subsequent day a new analysis has to be made. This would be the process if one works on the single time frame method. Now let's understand what happens if we shift to a multi time frame method, as I have taught in the past. In such a case, after having made the analysis that the market is indeed trending downwards on the hourly chart, and having noted the values at which many traders are likely to create positions, the day trader using multi time frame will now shift the assessment to the 15-minute chart, which means from the hourly chart the assessment will now shift to the 15-minute chart. And in this chart, the trader will add the indicator RSI with a setting of 4. The reason why we are choosing RSI with a setting of 4 is because we have 4 candlesticks of 15 minutes which will contribute to 1 hour. And as I have mentioned, that if we are analyzing the trend on the hour and checking checking the oversold and overbought conditions on the 15 minutes, then we must revise the settings to 4 instead of the default of 14. And what will this trader wait for? Just if you only focus on the RSI, the trader will wait for the RSI, which is currently placed at 50, to move up above the 70 levels. And once the RSI has moved up to above 70 levels, the only reason why the RSI would move up is because the price would move up from the current levels. And you would note that the price after moving up would fall somewhere in between the earlier marked range. And once the price comes in the range, which means it could be 22,125, 22,225, anywhere in the range that the price comes with highly oversold RSI conditions on the 15-minute chart, then the trade will move down to 5-minute chart. Due to some internet, it's just taking some time. And once you come on the 5-minute chart, all indicators are removed and the only focus is now on price action. So this is the current close of the market. We will have to assume that the day moves up and the market indeed comes between our red zone. And once the market comes in our red zone, we have this entire zone between 22,125 and 22,420 in order to sell. Once we have the price action within this zone, we will initiate a sell position only after the confirmation on the 5-minute chart, which means once the price reaches this zone in highly oversold conditions, and then we see bearish confirmations such as tactical bearish confirmations on the chart, at that point the individual will enter the trade of 22,500 put. The question is, what will be those tactical bearish confirmations? Tactical bearish confirmations could be of two types. The first one could be discretionary and the second one could be mechanical. If I were to choose a discretionary method of tactical confirmation, then the discretionary method would necessarily involve or include candlesticks. So here the trader would look at candlestick patterns in order to make a tactical confirmation. But if I were to use an objective or a mathematical method, so an objective method would be using a mathematical formula, a formula driven method for entry. What could be the formula driven method for entry? Many formulas are existing in order to take the trade. For example, a trader could simply include the super trend indicator, which is not present on this platform, but a super trend indicator where on the 5-minute chart, if it hits the red line, the trader will initiate a sell. Some traders could use the ATR method, whereby it means that if the security falls 1, 2 or 3 ATR from its pivotal high on the 5-minute chart, you will hit a sell. For example, if suppose during the day the price rallies up till here 22,275, and so far in the day this is the high, and obviously at this point the RSI on the 15-minute chart will be oversold. At that time the trader will simply note the ATR value of the security. In this current example it is roughly 15 points. What will be the objective? The objective will then be to simply sell 1, 2 or 3 ATR below the highest point. For example, I'll mark this here with a blue line. Let's assume that the market gaps up and continues to rally without a significant pullback on any time frame and creates a single wave high of 22,275. After which the market begins to start correcting a little bit, but we cannot be sure if this is the corrective wave or not. We will obviously see that the market will try to take out the new high, but till the point it has not taken out this new high, the previous high of the market minus 1, 2 or 3 times the average trading range on the time frame of action will be used to take an entry. Now if suppose the market continues to rally up, the trader who has used multiple time screen will not be getting initiated into the trade. Whereas if from this point the market, that is instead of rallying up, the market just hits a near double top, slightly lesser than the previous high, and rallies 1 ATR below, that is 22,260, or 2 ATR below, that is 22,240, at which point here the seller, that is the multi-time frame trader, will initiate a sell. Coming back to the main chart in question, what I would like to discuss here is that the trader has to eventually decide how complicated or how simple their system has to be. When I used to trade aggressively and consistently in my day trading, as a day trader, I used to trade on the 5-minute charts, but all of my assessments of the 5-minute charts or the 10-minute chart were actually derived from the assessment on the hourly chart. I would always trade in the direction of the hourly chart and wait for confirmation of other indicators on different charts in order to line them up so that potentially I'm capturing a big move. All that extra effort was predominantly designed to make me feel comfortable that I'm working hard in the market. In the long run, it has paid dividends. However, I have also noticed during my study that even simpler trading methods can make a lot of money. They might not be as precise, but they have the comfort of easy execution. This decision of which method to use will be yours, but if there is any key takeaway from this in the market, it is that if we see moving averages sloping downwards, and we see a rising gap between 2050 ADX trending above, then, and if you're using the hourly time frame, then all our assessment will be applicable for just one day. We will only sell the rise, we will only buy the put, we will only buy in the money put, we will note the levels at which we want to react, we will note the level at which we will certainly exit, and then from that point, how and when, the manner of the specifics of the trade, that is whether we go 1 lot, 5 lots, 10 lots, what do we do when the market gaps up, what do we do when the market gaps down, all these decisions are now for the trader to take. I hope that with this example, because Nifty has closed very close to the 20 period moving average, I have clarified the difference between single time frame and multi time frame trading, and that it's not that one is necessarily better than the other, but because they have a trade-off of hard work and specifics. With that, I hope you have learned a few more points. The day trader for the trade session tomorrow would continue to keep a sell bias on the market all the way till 22,500, and do not be an amateur and react at every point in between this range. Choose your levels in advance, or choose your levels looking at the intraday price action in the manner that I have shared with you. Only when the indicator becomes highly oversold on the 15-minute chart, look at the 5-minute chart for entry. If that criteria is not met, simply ignore it if you're a multi-time frame trader. The reason why these criterias are kept are to protect you. And if you do this long enough, sooner or later, you're going to catch a trade which is going to move in your favor, where all the criterias were met and you were protected for long enough to get significant exposure and confidence in your own ability. So with this, I hope we have learned a few things today. All the best.